Afternoon, everyone. On this lovely May the 14th with very warm temperature here in Edmonton. My name is John Gallo from Gallo LLP, and today I'll be talking to you about the budget update in this Friday afternoon lunch coffee chat. Looks like we have about half a dozen or so people here today. I'll continue to look off to my my right, your left to the screen to admit people if they come knocking. This is being recorded. At any time, if you have questions, please put up your hand, and I'll then allow you to provide you access to ask those questions, and we'll answer it at any time. Of course, this is recorded and will be put up on the web. So if it's specific to your business and you want confidentiality, please don't ask those questions, and I'll make sure I don't answer them. Okay, we just had a budget that came out in the last tail end of April. It was an exciting budget. No, not really, actually. There wasn't much that went on in it in terms of big sweeping changes. There was no capital gains reduction, no taxation on principal residence, no increase on corporate or personal taxes. So all those things we're really worried about related to the pandemic and paying for all the government subsidies hasn't happened yet. Not saying they are, not saying they won't, but it didn't happen in this budget. This budget is really more about a fine tuning of certain things, adding a few things, and really starting to, I don't want to use the word pander, but you know what? I'll use the word pander to perhaps some people that are crying foul to the rich not paying their fair share, and particularly to maybe moving money outside of Canada. So let's jump right into it. I have a PowerPoint here that I'm going to share with you, and you can follow along on your screen. Okay, start PowerPoint. What we'll be talking about today, like I had already mentioned in the introduction, is we'll start with kind of the key personal tax updates, and I'm just picking the key ones that will affect most of our clients and people here in Western Canada. Corporate tax considerations and changes. There's been a few juicy ones, and then some other items that I really think are projecting where the government's going and what we have to be maybe concerned, aware, or anticipate in the future. Okay, well, the first big concern, and I'm sure if you're listening to the news and the media during the personal tax season, was there was really a mismatch of the taxation of the CERB and the CRB benefits paid to people. These were the amounts paid individually. Most people receive T4s, T4As related to the pandemic, $2,000 a month that they got. But some people had to pay it back, and they paid back subsequent to December 31st, 2020. So there really was what we call a timing mismatch. And that meant they were going to be taxed on the benefits that they received in 2020, but they were ordered by government to pay them back in 2021. So the government came out in the budget in 2021, April 17th, and said, you know what, though the timing of payment was after the personal tax year, December 31st, 2020, you can amend your tax return and apply it to the 2020 year. So this will help a lot of people who have this really large tax bill and then also paid it back and wouldn't see that reimbursement until ordinarily April 30th, 2022, get that credit for the repayment of the benefit and not be taxed on it. So if anyone has that situation, the solution is simply amending the 2020 tax return. Next, interest relief on student loans has been extended, and that's been extended to March 31st, 2013. Oftentimes we get questions, you know, I have a line of credit to go to school, to med school, dental school, what have you. This is not the interest relief they're talking about. This is interest relief on specific student loans approved by either the federal or provincial governments, not personal loans taken to fund school. And oftentimes people get quite frustrated with that because it did go to their tuition, books, and what have you, but those are not the loans that they are talking about. Home renovation loans for energy retrofit, which also it kind of slid in there initially on the budget, and they're still working out the details I was talking to some people in the Department of Finance earlier in the week. We won't see full details until this summer, but it looks like they're going to give $40,000 for retrofitting. You'll have to have an energy efficient or energy saving inspection as part of the process to get the $40,000. This also applies to corporations that rent out units. What we're not too sure about, we know it's available for each home at an individual level, probably for your principal residence, and if you had, like, say, a secondary residence, a cottage or what have you, you could get those loans for both those properties because they're separate titles. What we're not too sure about is if you own a large amount of rental units inside a corporation, would that $40,000 be per unit? And I have no answer to that, but it's going to be very interesting if the government of Canada is looking to decarbon the economy and stimulate, and they have several other proposals that will help stimulate sort of the green economy and alternative energy sources. This would be a really key thing to do. If you allow a 100 unit apartment building to each get up to $40,000 for each unit to retrofit to make it more energy efficient, that certainly would spur on a bunch of companies out there that specialize in energy efficiency. So more to follow on that. They don't have the details on how long the program will be open for, or if there's a total amount for the program. But I'm sure the minute we get the information, sometime they expect in July, it would probably there probably will be a limit on it for sure. So certainly be ready to start that work and the applications for that work. That's going to make a lot of people quite busy, I think. Next is disability tax credit has been brought in. I have to say, about time. There are many Canadians that suffer from disabilities, and there's a very generous tax credit available at the personal level, but the bureaucracy and the paperwork around applying for it has always been pretty tedious. And there's been three big changes. One is they're expanding the concept of mental function. So they're recognizing that a lot of people suffer from mental illness, and they should also have access to the disability tax credit, and the requirements of the 5 daily functions of life, and substantially all the time, which is 90%, have been loosened in that regard for those people. They've also loosened up one of the requirements was 14 hours 3 times a week for to help the individual sustain the key qualities of life. They reduced that for mental function to add a significant partner to help the person. So if that combined hours is up to 14 hours, they will qualify. And this is a great improvement to the program. The last thing is they're minimizing the fees that what we call promoters of the program. So if you went to the internet and Google disability tax credit, you'd find a bunch of companies that will take maybe up to 25% of them of the refund that you could get back for applying for this, particularly retrospectively up to 10 years ago. Sorry, I just had to admit someone. So they're setting an upper limit on how much they can charge for that, which is really good because generally the people that need this credit are individuals that are in the lower income brackets, and of course their ability to kind of advocate for themselves has been hampered, and the fees should not be excessive to that. The next is the enhanced deductibility of certain classes of CCA. Now I'm going to talk more about that in the corporate section, but what I want to talk about here today is that if you're running a proprietorship and you have assets that have been capitalized, these rules will also apply to you on your personal tax return under proprietorships. Of course, one of the other things that was really flashy in the budget, and of course certainly was probably more political, and my understanding is that finance really didn't want to push this one through, but the luxury tax on cars, boats, and airplanes in relation to amounts in excess of. So the first thing is any cars or airplanes that you buy above $100,000 are going to be taxed, and there's a limit of either 10% of the total cost or 20% of the increase from over $100,000. So if you did the rough math, if the car or airplane was over $200,000, you take the 20% because it'd be a little less expensive. And for boats, the threshold, same sort of calculation, 10% of the total or 20% of the difference, but that starts at $250,000. And those are purchases starting after 1 January 2022. It's also inclusive of GST. So if you bought the car for $97,000 because you thought, it was under the limit, add the 5% and you're over the limit and you're paying either 10% on the total, which in that case would be silly because you're probably about $103,000, so you don't want to pay $10,000. You'd spend about 20% on the $3,000 or about $600 on a luxury tax in that example. Now, there are lots of exclusions to this, particularly related to what we call Class 10.1 vehicles, so trucks that are used for work and carrying equipment and people to the field and stuff like that. But this is really designed for that person that's buying a Ferrari or a Lamborghini or a nice, jet streamer to fly to Mexico to get some sun. That's really where this is focused on. Next, corporate tax highlights. Now, this is probably where most of you are super interested, and I'm not going into the details of every specific program because this isn't meant to be an exercise in mathematics. What it's meant to be is to give you as business leaders, the key things you need to talk to your team about or talk to us about changes. The first one is the wage subsidy and the rental subsidy has been extended with a phased out formula. Super important. The key deadlines is you're going to have the phase out program is going to go up till the 25th of September. However, government has said that they're allowed to extend that to November with a simple order in council. So they don't have to go back to Parliament to get an approval to extend past to November. But I think what's really important here is that the phase out program, and it phases down to about 20% in the last month, August to September 2025, so 25th of September, is that, when you're looking through your cash flow analysis and your budgeting, if you've been funding the business with the wage subsidy and the rental subsidy, there's certainly going to be some really tough decisions having to be made this summer around what's next and looking at the business and seeing how it's going to continue on without the wage subsidies. Worst case scenario, September 25th. Best case scenario at the end of November. So if you have any questions about how that looks and you want to do some cash flow analysis, please give me a call or send me an email and we'll start working on those cash flow analysis. The new program out there is the Canadian Recovery Hiring Program, CHIRP. Now, this program is new. It initially caused a lot of confusion because it sounded very generous. It works on the same criteria as the wage subsidy and the rent subsidy. However, it's an either-or proposition. So you can either claim CUs and CSRS, but you can't claim CUs, CSRS, and what I call the CHIRP. So you have to decide based on where your business is, the phase-out numbers, and if you're hiring, if this makes sense. Now, the timeline for this is slightly different, of course. It's running from 19 April, so the day of budget, until the end of this fiscal year. So you could, in theory, say, you know what, I'm receiving more subsidy under the CEWS. That runs till 25th of September. And then if things are still tough and you're hiring people, you can use the Recovery Hiring Program to push you through on till the end of the year. So once again, there might be some requirements to do some cash flow analysis, budgeting for the remainder of this year as things ramp up and the economy starts to get together, move forward, and your business enjoys its recovery. One of the biggest things that is going to be beneficial for most businesses in Canada, it's what we call Canadian Controlled Private Corporations, is the accelerated CCA. Very generous program that starts with anything you bought after 19 April 2021 or the day of the budget. The limit is $1.5 million. You can take 100% write-off of that $1.5 million amongst your associated groups. So it's not every corporation gets the 1.5 that's associated. It's the whole associated groups gets the 1.5 million. It's on any assets capitalized except for really class 1 through 6, which is buildings, some goodwill, and then some, of course, some infrastructure related to pipelines they've excluded out of it. So for a variety of political reasons, I am sure. The time frame for this is anything that's been bought from the date of the budget up till December 31st, 2023. So you have, and they say available for use. So it has to be bought and put into use before the end of the 2023 year. So provides a lot of opportunity for businesses to reinvest in assets, renew maybe their leaseholds, tenant improvements, buy new manufacturing equipment, whatever you think you need. These are the good years to do it because you can have the full write-off now. Now, I think one of the interesting comments on this that I've been thinking about is, if you have the ability to write off $1.5 million amongst your associated groups, and you have profit above the small business limit, there's going to be some math and some thinking around, do I want to use the whole 1.5 million write down in 1 year? You don't have to. You may want to carry forward to a subsequent year. So bring your taxable income down to that $500,000 small rate, and then save the remaining portion for the year after. So it's not necessarily a slam dunk that you want to use all of it in the first year, particularly if you're profitable above the small business limit, because I don't think there's any benefit wasting 100% write-off at essentially 11% tax rates. I would use it over 2 years and bring down my 25% tax rate to the 11%. I think is much better tax planning in my mind. The next is, the environment. They've created a couple new CCA classes on clean energy equipment, particularly to manufacturing bases that produce this equipment. Once again, enhanced write-offs above this $1.5 million program mentioned above. So they're excluded programs, and you can use both of them. If you're in manufacturing, particularly manufacturing related to solar panels or any sort of high energy or high efficiency sort of equipment, then this will certainly be something that's very, very interesting to you, and some planning in terms of cash flow enhancements and decisions around buying this sort of equipment may come into your annual budgeting discussions and planning. Next, mandatory disclosure rules. This is big. This is really, really big, but it's only big for certain companies. So, we've always had requirements to file certain elections with the government when we're doing it, what I'd call advanced tax work, rollovers, stuff like that. When you're taking certain tax positions related to financial statements, like using IFRS, future tax liabilities, what have you. Well, Department of Finance and CRA says, you know what, most of that stuff's probably good, but we want to know about it. So now they're creating a bunch of rules, and they're going to start in January. Of course, the detailed list and the nuances of the rules will be detailed later on in around July, with the rest of the budgetary stuff coming out about what has to be disclosed. Really what they're looking for is they can't see some of these more complicated tax transactions just by receiving a tax return, a T2 at the corporate level. So they want you to disclose this. And if you don't disclose it, the penalties are quite high. So as part of your tax planning, it's super important to, if you have transactions that are going ahead and you don't necessarily want to disclose those outside of the normal reporting requirements, you may want to push those ahead prior to January 2022. This, of course, will help them, audit more, and of course the hassles with audits, of course, and just the time associated and the costs associated with your professionals to assist with the audit. The next one, and I know I was quite worried about this initially, was the interest deductibility limits. Once again, the details, unfortunately, are coming out in July, but I think it's super important to talk about this for a variety of reasons. One, it will have a significant effect on some highly leveraged businesses. The net is cast, but it's cast at a very specific company. So just briefly, what they're saying is they're going to limit the amount of interest that's deductible. Now, once again, they're using the word associated group, so now it's not just one company, to 30% of the tax EBITDA. So what they're saying is they don't want companies to continually have a bunch of write-downs and losses and not pay tax because of interest. However, they've started to kind of outline their position, though it's not law yet, and they've added a bunch of exclusions. A couple of the exclusions is if the Canadian-controlled private corporations taxable capital is under $15 million. So that will take out a lot of kind of, the startups and middle-sized owner-managed businesses where they don't have, and when we talk about taxable capital, you could think of, retained earnings. It's not quite the same number, but it's a good kind of thinking. If you're close to 15 million in retained earnings, then you should be concerned, and we should kind of do some analysis of whether you're gonna be above that 15 million of taxable capital, or associated groups with net interest expense under $250,000. So if your interest expense is under $250,000 and you're a CCPC, you don't have to worry about these rules. If your taxable capital is less than 15 million, you don't have to worry about these rules as an associated group. However, if you're above that, you do have to worry about these new rules that will come into place. Now, I think one of the biggest things that will assist Canadian-controlled private corporations not to fall inside this 30% threshold is that you're allowed to spread it out amongst the associated groups. So if you have a large, complex corporate structure and you have high interest in one or two of your companies that may be above 30% of EBITDA, you get to blend it all in across your corporate entities. So imagine a scenario where you have a holding company, operating company, and of course you have your building company that maybe has high interest, or a rental company that holds your kind of what you call your long-term, retirement assets over here, and it has a high interest expense related to what we call tax EBITDA. You'll be able to spread that out amongst all of your companies, and most likely, more times than not, you won't fall in these rules. Really, what the government said, and they used a double negative, so I just want to read this out to you. It's intended to not apply to groups with no non-resident members. So essentially, it's intended to apply to groups with non-resident members. So that is foreign entities, foreign control. Really, if you think about it, what they don't want to happen is they don't want to lose, the government and CRA doesn't want to lose a bunch of potential taxable income via interest expense going to a foreign entity, which may or may not be taxable in their foreign jurisdiction and or at lower rates than Canada. That's really what they're looking for. So they cast a wide net, but they put a bunch of exclusions in, which will exclude most Canadian-controlled private corporations. But if you're a company that has family that have invested in preferred shares that maybe live in the United States, or you've taken a private equity firm on to help grow your business, you may find yourself in these. So be careful. The next thing that I want to talk about is Section 160. Now, Section 160 of the Income Tax Act, most of you will probably have never seen it. It is essentially a section of the Act that says if a company owes CRA some debt, whether that's payroll, so your RP account, your corporate tax account, or your RT account, your GST account, and you transfer some assets to someone else not at fair value, they can come back and go to that company that bought those assets not at fair value and take back or charge them with the amounts owing to the company that sold the assets. This provision, though very punitive, it's very hard for a transaction to fall into Section 160 unless it's very clear. I'm going bankrupt. I owe the government $1 million in payroll, and I transfer the assets of my company to my brother or some related person for $1. That's a clear violation of Section 160. But a lot of transactions are very gray, particularly when you're not related to the person. Well, Section 160 strengthens the teeth and makes it very clear that if there's doubt, it's in favor of CRA. So I think the takeaway is, if you're concerned about the going concern of your business, and you're thinking of doing some, questionable transactions or to someone you might know or you have a perceived relationship with, and those transactions are going to be done at what you believe is fair value, you may want to think twice about this, and you may want to get some third-party opinions on that transaction because CRA is looking for it. Other interesting items that came out of the budget and really kind of highlight some of the projections or the attitude where CRA and the Ministry of Finance is going. One, they've increased the funding for CRA to $330 million to do more audits. Now this ties into the government messaging around, the rich should pay, tax evasion's bad, all that sort of stuff, which it is, of course, but they're pouring more money into CRA to try to find more tax dollars. The question will be what will be their return on investment of that $330 million? Will they be chasing after, small business and, personal tax people for the $50 or $100 because they can't afford to hire, lawyers and accountants to defend them? Hopefully not. Hopefully they're going after the bona fide large tax avoidance schemes and tax avoidance taxpayers that they should be going after. But we will see. Government money is notoriously not spent well, so we'll see where it goes. They've changed the rules around late filing for both the wage subsidy and the rent subsidy, which allows for more room to adjust. Just a few months ago, CRA came out with an opinion saying, if you miss the deadlines, you can't adjust unless you adjust downwards. The Ministry of Finance and the government has loosened those rules and have allowed for a lot more adjustments in favor of the taxpayer, as long as there was essentially a bona fide reason for it. And they've listed a bunch of bona fide reasons. So I think the takeaway on this point is if you filed your wage subsidy or your rent subsidy and you thought you were statute barred, you couldn't amend upwards, you may be able to amend upwards. Give us a call, we can help you with that. They're phasing out paper notice of assessments, and taxpayers, particularly at the first level, will have to log into my account to download notice of assessments and other messages. This is a huge issue, and it's not just for personal taxpayers; it's for corporate taxpayers as well. If you're used to, not dealing with CRA unless you got something in the mail, you're going to have to create, as part of your battle rhythm, as I call it, your business battle rhythm, looking into my account on a monthly basis to make sure CRA hasn't contacted you. I suspect they'll create some sort of warning system. They'll send you an email, but the email won't have the information in it. You'll have to log on, download the information, notice of assessment. So a little more sort of burdensome, but they're trying to cut out the paperwork on a go-forward basis. Next, electronic payments for remittances, both GST and corporate taxes. They're going to phase out the ability to write checks to CRA. They're going to want electronic fund transfer. Once again, they're just trying to modernize their system and streamline payments. And very interesting is that they now have a team of 60 staff looking at social media influencers and accounts for unreported income. I'm sure many of you have heard the story of Al Capone, and the reason why he went to jail was what they did a net worth assessment on him, saying that he reported very little income, but he lived like a king. This is exactly what CRA is trying to do. They're going to look at social media influencers, the Instagrams and the TikToks, and if you're doing stuff in Mercedes and Ferraris and you're reporting $20,000 of income, they're coming knocking. I think, once again, the key lesson here is be careful with your posts. We've always said to our clients, you shouldn't be taking your corporate vehicle down to Kelowna with your big, company name on it and pulling your boat or your fifth wheel and not expect to get a call from CRA. CRA also takes vacations, and the one thing those agents hate to see is a corporate vehicle backing $250,000 boats into Lake Okanagan. That's just a recipe for disaster for a taxpayer. So they're doing it now on the internet. That ends our update. I'm going to bring it back to full screen and then open it up for any questions or discussions. Any questions or comments or thoughts or clarifications that people are looking for? It is 25 degrees out today, so I don't blame you. If you do, please feel free to give me a call or an email. I'll be more than happy to answer those questions, send you the PowerPoint, or go into detail on your specific concerns and the math around potentially some of your problems or considerations. Once again, thank you for taking time today. I'm John Gallo from Gallo LLP, and have a great weekend and enjoy the sun.